Crypto in 2026, the next economic turning point. Intra. First, welcome to this extended global report, Crypto in 2026, the next economic turning point. In this analysis, we'll explore how cryptocurrencies and digital assets are influencing the broader economy, what key developments to expect in 2026, and how the evolution of crypto finance may reshape monetary systems and investment behavior around the world. Section 1, setting the stage, from speculation to integration. First, let's look back. A decade ago, cryptocurrency markets were primarily driven by speculation. Now, in 2025, we've entered a new phase of integration, where digital assets, blockchain technology, and tokenization are gradually merging with the real economy. Second, the numbers. The total global crypto market capitalization sits near $1.3 trillion. Bitcoin alone accounts for roughly $600 billion, or about 45% of the total. Ethereum and stablecoins together represent another 30%, while emerging tokens and blockchain infrastructure projects make up the rest. Third, the evolution of stablecoins. These digital currencies, pegged to the US dollar or other fiat assets, now facilitate over $100 billion in daily transactions. They have become essential tools for global liquidity, cross-border payments, and decentralized finance. Fourth, central bank digital currencies, known as CBDCs. As of late 2025, more than 100 countries are testing or developing CBDCs. China continues expanding its digital yuan pilot, while the European Central Bank is advancing plans for the digital euro. The United States, meanwhile, remains cautious, exploring technical and privacy frameworks before a possible launch beyond 2026. Section 2, the role of crypto in the global economy. First, the macro connection. Crypto markets now move in closer correlation with traditional finance. When risk appetite increases, Bitcoin and Ethereum often rise alongside tech stocks and emerging market assets. During global stress, both tend to decline. This shift shows that digital assets are no longer isolated. They are becoming another reflection of the broader economy. Second, inflation and monetary policy. Crypto assets gained renewed attention during the inflation surge of 2021 through 2023. Bitcoin, in particular, was often called digital gold, though its volatility limited its effectiveness as a hedge. As inflation cools to around 3% globally by 2026, the question becomes, can crypto still serve as a long-term store of value, or will it remain a speculative asset class? Third, institutional adoption. Major asset managers such as BlackRock, Fidelity, and others have launched Bitcoin and Ethereum exchange-traded funds, bringing crypto exposure to millions of traditional investors. Corporate treasuries in technology and fintech sectors increasingly hold digital assets as part of their liquidity strategy. This growing institutional presence contributes to market maturity, but also tightens crypto's link to global financial cycles. Fourth, remittances and payments. Blockchain-based payment systems are quietly transforming cross-border transactions. In developing economies, crypto transfers are faster and cheaper than traditional banking methods. This practical utility may become one of crypto's strongest long-term use cases. Section 3, the road ahead. Scenarios for 2026 and beyond. First, the neutral scenario, gradual normalization. Crypto markets continue to mature. Regulation becomes clearer, reducing the risk of major fraud or collapse, but also limiting speculative excess. Bitcoin trades in a broad range between $40,000 and $60,000. Ethereum adoption grows through institutional and real-world asset tokenization. The overall market remains stable and increasingly viewed as a legitimate, albeit volatile, part of the global economy. Probability, about 55%. Second, the negative scenario, regulatory shock, or market stress. A series of events could undermine confidence. Perhaps a severe global recession, restrictive regulation in the United States or Europe, or large-scale hacks targeting exchanges or stablecoins. In this case, crypto market capitalization could drop below $800 billion. Investor sentiment weakens, liquidity dries up, and some blockchain projects fail. Probability, about 30%. Third, the positive scenario, accelerated adoption and institutionalization. In this outlook, global regulation stabilizes, central banks issue interoperable CBDCs, and major payment networks integrate crypto more deeply. Bitcoin could rise above $100,000 as institutional flows accelerate. Stablecoins and tokenized assets might represent over 10% of global digital payments by 2027. Probability, around 15%. Section 4, Key Forces Shaping the Future. First, regulation. The global regulatory map is still uneven. The European Union's MiCA framework has set a standard for digital asset transparency, while the United States is moving more slowly, balancing innovation with financial stability. Asia remains diverse. Japan and Singapore promote clear rules, while China restricts crypto trading but advances digital currency experiments. Second, technology. Scalability and interoperability remain the biggest challenges. Ethereum's Layer 2 solutions, new proof-of-stake networks, and zero-knowledge rollups are making blockchain faster, cheaper, and more sustainable. This technical progress could unlock broader applications, from tokenized real estate to decentralized identity systems. Third, environmental sustainability. Energy use remains a concern. Bitcoin's shift toward cleaner mining operations, now estimated at over 55% renewable energy, helps improve its image but continues to draw scrutiny. Newer blockchains, built on proof-of-stake technology, consume over 99% less energy than traditional proof-of-work systems. Fourth, integration with artificial intelligence. AI-driven blockchain systems are emerging in fraud detection, algorithmic trading, and decentralized data markets. This convergence between AI and crypto may become one of the most transformative technological trends of the decade. Section 5, Practical Outlook and Implications. First, for investors. Diversification remains key. Allocating a small portion of portfolios to crypto assets, typically between 1 and 5%, can offer asymmetric upside while managing risk. But speculative exposure should be balanced with stable, income-generating assets. Second, for policymakers. Digital assets can enhance financial inclusion and innovation, but they also challenge existing monetary systems. Policymakers must ensure strong oversight while supporting responsible development. Third, for businesses. The tokenization of assets, from real estate to supply chain goods, will reshape how companies manage ownership and liquidity. By 2026, tokenized assets could exceed $1 trillion in total value. Fourth, for developing economies. Crypto-based payment systems can reduce remittance costs and expand access to banking. For regions with unstable currencies, digital assets offer both opportunity and risk, depending on regulation and education. Section 6, Long-Term Vision, the Digital Economy 2030. Looking beyond 2026, digital assets could become part of everyday finance. Tokenized bonds, decentralized credit systems, and blockchain-verified identities may redefine how individuals and institutions interact with money. By 2030, the line between traditional finance and crypto may blur entirely. In this context, 2026 stands as a pivotal year, the bridge between experimentation and adoption. How governments, institutions, and individuals act now will shape whether crypto becomes a stabilizing force in the global economy or remains a volatile niche. Conclusion. To conclude, the outlook for crypto in 2026 is cautiously optimistic. A neutral scenario, moderate growth with expanding real-world use, remains the most probable at 55%. A negative downturn carries 30% risk, while a bullish acceleration remains possible at 15%. In short, the world is witnessing the transformation of money itself, from paper and central control toward programmable, digital, and decentralized forms. Whether this evolution strengthens or destabilizes the global economy will depend on how wisely we balance innovation, regulation, and trust.